Welcome to the Ultimate Forex Masterclass. Today, we are embarking on a 10-minute deep dive to master the world's largest financial market, covering everything from the absolute basics to professional strategy. The scale of the Forex market is staggering. It trades over $6.6 trillion every day, dwarfing all other financial markets combined. This liquidity is what makes it so attractive to traders. Foreign exchange, or Forex, is simply the process of exchanging one currency for another. Whether for travel, business, or investment, it's the lifeblood of global commerce. For beginners, Forex offers unique advantages. It's open 24 hours a day, 5 days a week, and requires relatively low capital to get started from anywhere in the world. In this market, currencies are always traded in pairs. When you trade EUR/JART USD, you are making a bet on the value of the euro against the US dollar. The first currency, the euro, is the base. It's the unit you are buying. The second, the dollar, is the quote, which represents the price you pay for 1 unit of the base. Every currency pair has a bid and an ask price. The tiny gap between them is the spread. Think of this as the transaction cost paid to your broker. Price movements are tracked in pips. For most major pairs, a pip is the 4th decimal place. Understanding pips is crucial for calculating your gains and losses. Many modern brokers use a 5th decimal place called a pipette. It represents 1/10 of a pip, offering even more precision in the pricing you see on your screen. The majors are the most traded pairs in the world. They all include the US dollar and are known for their high liquidity and lower trading costs. The market day begins with the Asian session, led by Tokyo. This is often a period of lower volatility, focusing on currencies like the yen and Australian dollar. As Tokyo winds down, London opens. The European session is the most active time of day, as London is the global hub for foreign exchange trading. Finally, the New York session opens. The overlap period between London and New York is when the market sees its highest volume and most significant moves. Forex is traded in lots. While a standard lot is 100,000 units, beginners typically use micro lots of 1,000 units to manage their risk effectively. Leverage is a powerful tool that allows you to control large positions with a small amount of capital. It can magnify your profits, but it also increases your risk. Margin is the good faith deposit you provide to your broker to open a leveraged position. It's essentially collateral for the funds you're borrowing. Most traders use candlestick charts. The rectangular body of the candle shows the distance between the opening and closing price for that time period. The thin lines, or wicks, represent the price extremes, the highest and lowest points reached during the candle's time frame. Green candles are bullish. They indicate that the closing price was higher than the opening price, meaning buyers were in control. Red candles are bearish. They show that the price closed lower than it opened, signaling that sellers dominated the market during that period. Support is like a floor. It's a price level where a falling currency pair tends to find buying interest and stop dropping. Resistance is the ceiling. It's a price level where a rising pair often faces selling pressure, making it difficult to break higher. Trend lines help us visualize market direction. An upward trend line connects a series of higher lows, confirming that the bulls are in charge. A downward trend line connects lower highs. As long as the price stays below this line, the bearish trend is considered to be intact. Moving averages are essential tools. They smooth out price fluctuations to help you identify the overall trend more easily over time. The RSI, or Relative Strength Index, is a momentum indicator. It tells you when a pair is overbought or oversold, helping you time your trades. Fibonacci retracements are hidden levels where prices often reverse. Many traders watch levels like 50 and 61.8% for potential trade entries. Volume measures the strength of a price move. High volume during a breakout suggests that the move is significant and likely to continue. Fundamental analysis is the study of the why. Economic news, like interest rate decisions or employment reports, can drive massive market volatility. Central banks are the most influential players. Their policies, especially interest rate changes, are the primary drivers of long-term currency value. Key economic indicators like GDP and inflation are critical. A healthy, growing economy typically results in a stronger national currency. Trading styles vary. Scalpers operate in minutes or even seconds, looking to capture tiny price moves multiple times throughout the day. Day traders open and close all their positions within a single trading day. This avoids the risk of price gaps that can happen overnight. Swing traders take a longer-term view, holding positions for days or weeks to capture larger price swings or trends in the market. Success is about your risk-to-reward ratio. Always look for trades where your potential profit is at least 3 times your potential loss. Apply the 1% rule. Never risk more than 1% of your total account balance on a single trade. This keeps you in the game during losses. Don't focus on just one pair. Diversifying your trades across different currencies and assets can help lower your overall portfolio risk. A stop loss is your essential safety net. It's an order that automatically closes your trade at a set price to prevent catastrophic losses. A take-profit order ensures you walk away with your gains. It automatically closes your trade once your profit target is reached, removing the emotion of greed. Trading is largely psychological. Fear can cause you to hesitate or exit too early. You must learn to trust your analysis and your plan. Greed is dangerous. It leads to overtrading and taking too much risk. Stay disciplined and focus on consistent, sustainable growth. Never revenge trade. Trying to get back at the market after a loss leads to reckless decisions. If you lose, step away and reset your mind. Treat every loss as a lesson. Professional traders analyze their losing trades to understand what went wrong and how to improve their system. Choose a time frame that suits your personality. Short time frames are fast-paced, while higher time frames like the 1-hour chart are often more stable. When you find a setup, you open a new order. Select your currency pair and enter your lot size based on your risk management rules. Crucially, enter your stop loss and take profit levels before you click execute. This ensures your risk is controlled from the very start. Now, decide your direction. If you expect the price to rise, you buy. If you expect it to fall, you sell. In Forex, you can profit in both directions. Your broker is your gateway to the global market. Choose one that is highly regulated and offers the tools and spreads you need to succeed. Always verify your broker's regulation. Trading with a licensed broker is the best way to ensure that your funds and your trades are secure. MetaTrader 4 and 5 are the industry standard platforms. They are powerful, widely used, and offer all the charting tools a beginner needs. Start with a demo account. It's a risk-free environment where you can practice your strategy with virtual money before committing real capital. Backtesting is vital. By testing your strategy against historical price data, you can build confidence and understand how your system performs over time. Maintain a trading journal. Documenting your successes and failures is the most effective way to identify patterns in your own behavior. Be cautious of scams. Real Forex trading takes time and effort to master. Avoid anyone promising easy money or guaranteed high returns. Understand the power of compounding. Small, consistent profits can grow exponentially over time if you manage your risk and stay disciplined. The non-farm payroll report is a massive news event. Occurring every month, it causes high volatility and can dramatically move the markets. Successful traders find a balance, combine technical indicators with fundamental news to gain a holistic view of the market's next move. Markets are connected. For example, gold and the US dollar often have an inverse correlation. Understanding these links is a key advantage. Your roadmap to success is clear. Build your education, practice on demo, master your strategy, and maintain discipline. These are the pillars of a pro. Finally, stay updated with market news and trends. The financial world moves fast, and continuous learning is the key to staying ahead of the curve. Forex trading can be a path to financial independence, but only for those who treat it as a professional business. Master the craft, and the rewards will follow. Good luck!